Let's talk about two things that can upend your life in ways you might not expect: recessions and the housing market. These aren't just topics for economists or people on the news. They're forces that can shape your everyday reality, sometimes overnight. Whether you're a homeowner, a renter, or just dreaming of your own place, these issues touch everyone. A recession is when the economy shrinks for months at a time, businesses slow down, people lose jobs, and the sense of security we often take for granted can vanish. It's not just numbers on a chart. It's your favorite coffee shop closing, your neighbor suddenly out of work, and a general feeling of uncertainty that creeps into daily life. The housing market isn't just about buying or selling a home. It's a high-stakes gamble that's closely tied to the health of the entire economy. When things are good, home values rise, and people feel wealthier. But when the economy stumbles, the housing market can quickly turn from a dream to a nightmare. When the economy tanks, the housing market usually follows right behind, dragging home values down with it. Suddenly, that investment you thought was rock solid can start to feel a lot less secure. Your house, likely your biggest asset, is deeply connected to the economy's ups and downs. When times get tough, paying the mortgage can become a struggle, and the value of your home might drop, leaving you feeling trapped or anxious about the future. When warning signs start flashing, like rising unemployment or falling home prices, the housing market is often the first place to feel the pain. It's a signal that things might get worse before they get better. This isn't just about home upgrades or renovations. It's about the stability of your entire financial life. The ripple effects can impact your savings, your plans for the future, and even your peace of mind. Tonight we'll dig deeper and see just how shaky that foundation can get, and what you can do to protect yourself when the ground starts to move. There's a common belief that housing is somehow recession-proof. The logic seems simple. People always need a place to live, so surely homes must be a safe investment, right? This idea is repeated so often that it feels like a fact. But let's take a closer look at what really happens when the economy takes a turn. The truth is, needing shelter and being able to afford it are two very different things. During tough times, job losses and shrinking savings mean that even people who want to buy a home may simply not have the means to do so. The dream of homeownership can quickly become out of reach for many families. It's easy to forget that the 2008 financial crisis actually began with the housing market. Back then, millions lost their homes, and entire neighborhoods were left empty. The myth of housing's invincibility was shattered for many. High home prices don't always mean the market is strong. In fact, they can be a warning sign, a bubble inflated by easy credit, risky loans, and wishful thinking. When the bubble bursts, the consequences can be severe. Every recession is unique, shaped by different causes and effects. Just because housing survived one downturn doesn't mean it will be safe in the next. Past performance is never a guarantee of future results. When the economy slows down, people can't just buy homes because they want to. Lenders tighten standards, buyers get nervous, and sellers are left waiting. The market can freeze up almost overnight. The comforting story that house prices only go up is just that, a fairy tale. Real estate values can fall, sometimes dramatically, leaving homeowners and investors with big losses. The reality is, a recession can expose just how fragile the housing market's foundation really is. What seems solid can quickly become unstable when economic winds shift. So don't fall for the sales pitch that homes are always a safe bet. Instead, look at the facts, understand the risks, and make decisions based on reality, not myths. Recessions hit the housing market first through job losses. When paychecks stop, mortgage payments become impossible, and foreclosures rise. Even those with jobs face wage cuts or freezes, making it harder to keep up with bills. New buyers get scared off, shrinking demand. More people try to sell, fewer can buy, prices drop fast. It's a classic supply and demand crash. The dream of homeownership can quickly turn into a nightmare. In a recession, the housing market's fall can be swift and brutal. Banks are eager to lend money when the economy is booming, handing out loans to businesses and families with little hesitation. But when a recession hits, that generosity vanishes almost overnight. Suddenly, banks become extremely cautious, pulling back on lending and making it much harder for anyone to borrow money, no matter how strong their finances might seem. Lending standards tighten dramatically. Now, only borrowers with flawless credit histories and substantial down payments stand a chance of getting approved for a mortgage. Even small blemishes on a credit report can mean instant rejection. Even buyers who would have easily qualified just months before are suddenly turned away. the pool of eligible homebuyers shrinks rapidly, leaving many would-be homeowners stuck on the sidelines, unable to move forward. Sellers, in turn, struggle to find buyers. Deals that seemed certain fall apart at the last minute, and the real estate market grinds to a halt as transactions dry up. As more people lose their jobs or see their incomes drop, they can't keep up with mortgage payments. Foreclosures surge, and banks are forced to repossess homes, flooding the market with distressed properties sold at bargain prices. Home prices begin to spiral downward, leaving many homeowners owing more on their mortgages than their homes are worth. This traps families financially, making it nearly impossible to sell or refinance. It's a vicious cycle. Each new wave of foreclosures pushes prices even lower, which leads to more defaults and even more foreclosures, deepening the crisis. The credit squeeze doesn't just slow the economy, it can turn a mild downturn into a full-blown financial crash, as fear and uncertainty spread through the system. The system begins to feed on its own panic, with bad news triggering more fear, more selling, and even tighter credit, creating a downward spiral that's hard to stop. When home prices fall, everyone feels it, not just sellers. Home equity vanishes, net worth evaporates, and people stop spending, deepening the recession. Underwater mortgages trap families, making it impossible to move for work. Bank failures can follow, threatening the whole economy. The housing market relies on jobs, income, and credit. Recessions shatter all three. The belief that it's different this time is dangerous. A big enough recession almost always leads to a housing crash. When one falls, the other is sure to follow.